Joining me right now is CIT Fixed Income Senior Vice President, Portfolio Manager Bryce Doty. Also joining and Kingsview Asset Management Chief Investment Officer, Fox News contributor Scott Martin. Great to see everybody this morning. Thank you so much for being here.
Thanks, John.
Hey, guys.
Morning.
And Bryce, let me kick it off with you. We are expecting to hear from the Federal Reserve today after a two-day meeting. What are your expectations from the Fed? We know that rates are expected to stay at these levels until 2024, I believe.
Yeah, when Fed Chair Jerome Powell speaks at his press conference today, he's probably going to be pretty depressing when he talks about the economy and the justification of that poor state of the economy for why they're extending all these lending programs. And we don't think investors are going to like it. We think investors will essentially howl at Powell today, and it could be a dip. I mean, I get it. He's facing the harsh, cold facts that things are really bad. He knows that schools are going to be reconvening soon. He's looking out. 1 or 2 quarters, there's probably going to be another spike in coronavirus cases before a vaccine comes out. But we're firmly in the buy the dip, the vaccine trade. So we have a little powder dry. We're looking to take advantage of this, what I refer to as the howl at Powell trade today. And we'll see how that plays out. But that's kind of how we think the market's going to react to his comments this afternoon.
And of course, the Fed already announcing it is extending the emergency lending program through December. That emergency funds were set to expire in September. So the stimulus keeps on coming. Does that affect what you're doing, Bryce?
It does. So on one hand, you have this bolstering of the economy, and it certainly is definitely helping corporations be able to borrow money at extremely low rates. That's been fantastic. I mean, they're doing everything they can. And his message will be that they will continue to do everything they can, whatever it takes to get us over the hump, to get companies the liquidity they need to survive to next year. In doing so, he tends to just talk about all the really bad things going on with the economy and employment and things as well. But when you look out past 6 months, though, there could be an incredibly strong rebound in the economy. There's a lot of pent-up demand out there. People are itching to get out and spend money again. As soon as they feel safe at all, you're going to see a big pop. The treatments have been better. The fatality rate's coming down. So there's a lot of positive momentum there. We just need to get past the next 3-4 months, and I think we'll be in a better track. So we like all of that, and anytime there's a dip or hit, we're going to take advantage of it.
Well, you make a good point. Scott Martin, jump in here, because Larry Kudlow yesterday told Fox Business that he sees the V-shaped economic recovery still intact despite the coronavirus resurgence. So he was looking, Scott, for a 20% growth story in the second half is what he told us last time Kudlow joined us.
Yeah, that'd be awesome. And it's probably just a delayed V more than anything, Ray. We probably thought we were going to get into that V just about now, and it looks like it's a couple months off. But something to your point, Bryce, let's just say that things do start to reaccelerate, as you just noted, in the fall and into the winter. Do you think then the Fed eases off the stimulus kick, and then we actually maybe see, a steepening of the yield curve over time here, therefore helping the banks?
I do. I agree that, let's say there is a vaccine that comes out. There's a lot of hope. There's going to be a huge market reaction when that happens, right? You might want to take some money off the table, because the next step isn't so good for investors, even though it's really good for the economy. So everything's going backwards. Whatever's bad for the economy ends up being good for the markets, because the Fed is going to just throw a ton of money in there and a lot of stimulus. And then you're right. If the economy gets traction, they're going to pull back. The curve will steepen. That will be good for banks. It wouldn't be good for longer bonds. And I think that they'll pull back on their purchases of corporate bonds for sure. The lending programs they haven't done a ton, but that'll probably lessen. So it'll be this balancing act that whenever you see some sort of strength in the economy, as an investor, you have to think, okay, now the Fed's not going to be quite as aggressive. So it's almost like, be a little bit of a contrarian on economic news, and definitely the volatility that we're going to see in the markets is just higher than it was the last few years. So we think that's an opportunity, frankly.
Bryce, it's great to have you this morning. Thanks so much. We, of course, will be watching the developments. Bryce Doty joining us there. We are just getting started this